Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in this episode, I want to talk about a measure called return on borrowing capacity. You might not have heard it before, and the reason for that is I just made it up. But really, the premise is, and the thing that I've been thinking about for quite some time, because I've been sort of stewing on this podcast episode for a while, is that really borrowing capacity is most investors' scarce asset. I mean, a lot of people think maybe great investment opportunities might be the scarce asset, but the reality is there tends to be quite a few good quality investment opportunities out there. But because borrowing capacity is the scarcest asset, we need to allocate it in the most efficient and effective way. And really, the goal is to ensure every dollar of borrowing capacity is producing the highest amount of wealth, or will produce the highest amount of wealth in the longer run. And so instead of looking at measures like return on cash flow or return on capital or just a specific asset return, I think we should be thinking about return on borrowing capacity, because that's what I can deploy into the market, and that is limited for a couple of different reasons. Now, of course, I've spoken a number of times about borrowing to invest in this podcast, and you can do that with any asset class, of course. Most people feel more comfortable doing that with property just because it tends to have lower volatility, borrowing costs are lower, and we can borrow a greater proportion of the property. But of course, borrowing to invest makes a lot of sense, right? Because I can say, for example, invest $10,000 a year for the next 10 years, or I can go and borrow $100,000, dump that into an investment, and then spend the next 10 years using that $10,000 to repay the loan. And of course, as long as my returns exceed my borrowing costs, and they probably will, particularly if it's a good investment, of course, then I'm off to the races. But even as a mechanism of sort of bringing forward future cash flow and investing today, apart from that, even if we didn't decide to repay debt, it still makes sense as an appropriate investment strategy for many people. And of course, we talk about how returns compound, and particularly capital returns in investments, and that does really all the heavy lifting in terms of building wealth. Well, the inverse is true with loans, and because the inflation rate eats away at the dollar value of the loan. So $1 million loan today, it's a pretty big number. I mean, when I started the business 20 years ago, $1 million loan was a very big loan. Like, that was significant, probably sort of like $3 million today. Now, I haven't worked out the numbers, but I'm going to just say in terms of how common it is, or uncommon, I should be saying. But $1 million loan today, big number. But in 30 years' time, if we just assume normal inflation rates, it's worth $450 in 30 years' time, if we're looking at sort of parity. So we know that not only are we investing assets that compound, but inflation is eating away at the loan balance. But unfortunately, we don't have an unlimited borrowing capacity. I mean, almost every single person in Australia has a limited borrowing capacity. And if we think on global standards, okay, maybe Elon Musk or Jeff Bezos or whatever, I mean, maybe they have an endless borrowing capacity, but, those guys aren't listening to this podcast. So, most of us have a limited borrowing capacity. And it's limited for two reasons. One of two reasons, typically, either by the banks in terms of their credit policy, or by our own personal circumstances. Now, banks have dictated by strict credit policies, some dictated by law, some by, risk management within the bank, but they have got certain credit policies. So either you can fit inside their box and their checklist, and that's great if you do, but there's going to be a limit in terms of what they will lend you. Or sometimes you can find people in circumstances that don't fit the bank's credit policies, and therefore, whilst they might be a little bit unconventional and they might still be able to safely borrow money, they're not able to do so just because it's so codified. So in that situation, we might have clients that certainly could afford to borrow more, but just can't because they're locked out of the credit market. And just as a bit of a sidebar, I think there needs to be a bit of a carve out for credit policy, just like there is in financial planning. So in financial planning, you could be a wholesale sophisticated investor. And if you are, you're able to access different investments under different terms and conditions with different sort of rights and oversight. And that's appropriate in some circumstances. And the same for credit policy. I think that if you're a very wealthy individual, or you've got completely different circumstances to a, mum and dad home loan customer, there should be a carve out for you so you don't have to necessarily jump through all those hoops. But anyway, that's just common sense, isn't it? Anyway, so obviously your borrowing capacity can be limited by the bank's credit policy, or alternatively, your borrowing limit might be self-imposed. So you might be feeling comfortable borrowing to a certain level just from a risk profile perspective, or maybe, according to your sort of goals and strategy, stage of life, all these sorts of things, it might not be appropriate for you to borrow more. Yeah, you might be comfortable, but you feel like it's not appropriate given your circumstances. But the point is, everyone has a limit. That limit could change over time. So, if you're just starting out your investment journey, it's probably quite limited. As your income profile grows and your financial position strengthens, your borrowing capacity might grow. So it might change over time, but everyone has a limit. And so we really should be thinking super carefully about how that limit is allocated. As I said at the beginning, there's an abundance of investment grade property or other good quality assets we can invest in. So even if we think that, less than 5% of a property in Australia is considered to be investment grade, and I think that doesn't sound unreasonable, that's still $580 billion worth of property to choose from. So as you can see, finding the right property, probably not a difficult thing, or finding the right properties, even if I'm going to go buy 10 of them. With time, I'll find those good quality assets. It's really the borrowing capacity that I really need to think about and make sure we're allocating it to achieve the best outcome. And so, for instance, if my borrowing capacity is, say, $1 million, then the thing I need to ask myself is, how do I allocate that $1 million borrowing capacity to achieve the best outcome? And by best outcome, I really mean the highest dollar value wealth, because ultimately that's what most of us are aiming for, which is funding retirement. We're going to fund retirement in dollars, in terms of living expenses, travel expenses, whatever we want to do. They're going to cost me dollars. It doesn't cost me percentages. And so ultimately, I think it comes back to, how do I allocate that $1 million borrowing capacity so that it achieves or acquires the greatest amount of net worth after tax? And it was actually a point I tried to make in episode 331, where I talked about internal rate of return, which is a mechanism for measuring how effective an investment is. And I applied it to a property investment scenario. And I thought I was pretty happy with that podcast episode. So if you missed that one, go back and have a look at it. I think it really puts some numbers around the strategy that I advocate in that episode, which is buy for growth. And then once you have that property, tilt towards income. So just think only about income after you buy the property. But the point is that sometimes you can do an internal rate of return calculation, and one investment will give you a 15% internal rate of return, and then option B will give you, say, a 14% internal rate of return, and you think, well, option A is better because it's slightly higher internal rate of return. But the other thing you've got to think about is, how many dollars does that actually generate? Because if option B requires more cash flow, you get the opportunity to invest more money in a good investment. Whereas if option A, still very high internal rate of return, but because of its cash flow position, actually doesn't require you to invest much. And as a result, it won't accumulate much in terms of wealth. So at the end of the day, they're all percentages, right? But if I've got $1 million borrowing capacity, how can I put that to work so that in 30 years' time, I'll have $3 million after tax, after I've repaid the loan, after I've paid capital gains tax, all that sort of stuff. If I can do that, that to me is a pretty good outcome. Now, I just pulled that $3 million out of the air, by the way, but that's kind of just to make that point. Now I've done some scenarios, as you would expect. Anyone that listened to this podcast for really any length of time knows that I love to dig down in the numbers and look at the evidence. And so when I thought about, well, how are we going to measure return on borrowing capacity? What's the best way to do that? I think that's the best way, is to work out, if I deploy this $1 million into a particular investment, I then need to form a view on what the potential outcomes could be. So in terms of future investment returns, and then I need to calculate, net of everything, tax, cash flow, all those sorts of things, how well am I going to do in terms of how much wealth in today's dollars am I going to accumulate? And so what I've done is looked at 4 property investment scenarios, and I've used that $1 million borrowing capacity as a benchmark, and I've assumed a total return of 9%. And it's the makeup of the return that differs. So I've looked at a property that delivers 2% income and 7% growth, 3% income, 6% growth, 4% income, 5% growth, and 5% income, 4% growth, but still the 9% being the total return. Now, it's really interesting that I just answered a question over on YouTube today from someone that was saying, well, I hear what you're saying, but I've invested in small regional towns and my property has tripled in value over the last 16 years, which is about a 7.1% return. And that property was neutrally geared which I don't know the details, but suggests to me that, the yield's going to be pretty high. So 7% growth, and maybe they've got a 4 or 5% yield. So a total return of 11 or 12%. That's pretty good, and that's very good if you think the property is located in a secondary location from an investment grade perspective. And that can happen, but whether that return will persist perpetually or whether that return was delivered not equally over the last 16 years, but in maybe the COVID period, it got a spurt. And if we had that conversation 5 years ago, maybe the returns wouldn't have been good. I don't know what the answer is, and good on that person. But the point is that if I'm going to develop an investment strategy, I need to make some assumptions about what returns I think I can achieve. And I want to make sure those assumed returns have a high probability. So it's going to work, or at least it's got a very high probability of working. And so to my mind, if I'm going to embark on an investment strategy, I need to assume the total return is going to exceed 10%. And 10% I think is a good benchmark, because when you look at property returns in the long run in terms of rental yield and growth, and when you look at share markets, they're all around 10%, if you look over sort of 40 decade periods. So I think if you're going to advocate an investment strategy that you want people to believe that it's going to generate returns of more than 10% per annum, I think you've got to be cautious of that. Now, good on that person that made the comment on YouTube, and I'm very happy that people build wealth, and I'm not saying it's my way or the highway, that my way is the only way to build wealth. But my point is that if I'm going to make really important financial decisions like this, as in how am I going to deploy my borrowing capacity, I absolutely certainly want to make sure that I'm using realistic assumptions. So in the effort to be a little bit conservative, instead of going 10%, that's why I've used the total return of 9% in my numbers. Now, of course, we want to swing for the fences and hope for, plan for the worst, hope for the best. So of course, I hope that if we make good quality investments, our overall return over a very long period of time will be more than that. But I don't think I'm going to make important decisions like allocating borrowing capacity, assuming that I'm going to earn what I would regard as a unrealistic return on a long-term basis. So I've got a table on the website that compares the outcome of those 4 different investment property situations. Total return of 9%, just the difference between income and growth. And what I've done is I've measured 2 things. Firstly, the after-tax holding costs, the initial after-tax holding costs. Because of course, if we're comparing these 2 different types of properties, one that's very low yield and one that's very high yield, of course, the affordability of those 2 different options is going to be different. And I acknowledge that from a practical perspective, there's going to be a larger cohort that can afford a property that costs less in terms of holding costs. And so sometimes I get this sort of feedback on social media to say, oh, look, not everyone can afford a massive negative cash flow property. And I get that, but that's not my job in this podcast. My job in this podcast is to, as I see it, is to educate people to make the best quality decision. Now, they need to then apply it to their own circumstances. And I'm not dictating that everyone should go in this direction. But if you're going to go in a certain direction, but otherwise you could have taken a different approach, that's where this podcast fills that gap, I hope, anyway. So I've outlaid the holding costs, and this is going to be important in my argument too, so I'm going to come back to that in a second. So actually, I might just mention, just to put some context around this, I'll compare either ends of the spectrum. So I'm going to compare the low yield property that gives us 2% income, 7% growth, to the high yield property that gives us 5% income, 4% growth. And the holding costs after tax per month for the low yield property are about $2,200. And very neatly, the holding costs for the high income property, is $1,100, exactly half of the amount to hold the low yielding property. And I'll come back to this point in a second, but what I've done is I've calculated how much wealth would these 4 different investment property options generate over 10, 20, and 30 years. And to calculate that amount, I have looked at the capital growth, less capital gains tax, less repaying the loan, less the negative cash flow. So to compare apples with apples, I'm taking out this negative cash flow, the $2,200 a month that I'm paying in terms of holding costs, in order to calculate how much better am I for having this property investment. And then what I've done is discounted the numbers in today's dollars. And I think always expressing numbers in today's dollars makes it a little bit more relatable. So, what are the answers? Well, the high growth, low yield property, 2% income, 7% growth, in 30 years' time will generate $2.15 million worth of net assets in today's dollars. So you're taking $1 million of borrowing capacity, and essentially, if you can wait 30 years, you'll generate twice that amount of borrowing capacity in net worth after tax, which is important. The high income, low growth property, so 5% income, 4% growth, 920,000, so less than half the amount that the high growth property. Now I've got some figures over 10 and 20 years. Over 20 years, it's more than $1 million versus just slightly more than $500,000, but the numbers don't really change in terms of how they compare. So here's the conclusion, if you like. This is the key thing. As I said, the low income property costs $2,200 per month and generates $2.15 million over 30 years. The high income property costs half that amount and generates just less than half the amount of wealth, $920,000 over 30 years. So someone could come to me and say, well, what's the difference, Stuart? Because I could just buy two of the high income properties. So the holding costs of two high income properties will be exactly the holding costs of one lower income property. And if I just double the net worth, it gives me $1.8 million versus $2.15 million. Okay, there's $350,000 in today's dollars differential there, but the number's broadly in the same vicinity. So there's actually no downside necessarily to going for high or investing in high growth property as long as you invest more of it. And this is the thing that I've seen spoken about from time to time, that, if I buy high yield property, it extends my borrowing capacity and I can buy more of it. But the point here is what that analysis or that argument doesn't acknowledge is that borrowing capacity is limited. So in the situation where I've only got $1 million borrowing capacity, if I put it into two $500,000 properties yielding 5% and 4% growth, I'm going to end up generating less than half the amount in today's dollars after tax. Whereas if I've got $1 million borrowing capacity and I put it all in one lower income property, I can generate more than twice as much wealth over that period of time. Now, of course, that doesn't acknowledge the fact that the amount that I'm putting into the property, the negative cash flow is different, and that's not going to be affordable to everyone. But for those people that it is affordable to, that's the better decision. That's the decision that generates the highest wealth. And as I said, the other argument is, well, if I invest in higher yielding property, that is going to enhance my borrowing capacity. And it's true, of course, the additional rental income is included in borrowing capacity, and most banks take about 80 to 90% of gross rental income. So they're making allowance there of 10 to 20% for expenses, which I think is probably too low, realistically. But anyway, they take 80 to 90% of gross rental income towards serviceability. But what they do on the other side, in terms of the loan that's related to that property, they calculate the repayments based on 25 years typically at an interest rate 3% higher than the current rate, which is going to be sort of 8.5% to 9%. So I worked out that an extra $100 per week of gross rental income might increase your borrowing capacity by about $43,000 to $48,000. Now, you might be in a situation where your financial position is really tight, and in fact, targeting a property like that is really important, and I acknowledge that. But for the people that aren't, they've got to realize, that they're in a financial situation where they've got relatively strong cash flow. They've got to realize then that borrowing capacity is not that sensitive to rental yield. It has an effect, but it's not huge. And so the idea or philosophy thesis that I should target high yielding properties and that's going to dramatically change my borrowing capacity, I think in many circumstances is false. Now, allocation of borrowing capacity and return on borrowing capacity isn't just for investors that are investing new monies into the market. I think we can all property investors can reflect on this measure of returns. So we know that property market returns can be unpredictable. They're very rarely in straight lines. I've spoken before about how property markets tend to move in cycles, growth and flat cycles. And if you happen to be in the right place at the right time, or you're very smart and you are able to invest just before a growth cycle, it's quite possible that you've enjoyed above average returns. But really the key question is to consider whether those returns are realistically likely to continue over many decades. Because if you don't believe that, if you've happened just to be the right time, right place, for example, if you bought a property in a location in 2019, just before COVID, that's had a boom through COVID and then a boom through a high interest rate environment, which many, more affordable markets did. It's quite possible that you've seen, maybe 10 or 20 years of growth in only the last 5 years. And if you believe that's unlikely to persist, if you take the view that that's what you've experienced, and as a result, the next decade's probably not going to be so great in terms of future returns, then it might be appropriate for you to reallocate your borrowing capacity into an investment that's going to generate better future returns. Let me use a little bit of an example. And this example is not what I think necessarily will happen, but it's just a theoretical example. So let's take Brisbane, for instance. Since the start of 2019, the median house price has grown about 9.1% over the last 6 years. And in fact, a lot of property in Brisbane in good quality areas has done better than that over the last 6 years. So significant growth. Now, if we were to assume that Melbourne was to deliver the same sort of growth over the next 6 years due to mean reversion, and if we assume that the Brisbane market is going to flatten out, then even taking into account transactional costs, tax like capital gains tax and so forth, buyer's agent fees, you could still theoretically end up doubling the amount of wealth that you accumulate by selling out of Brisbane and buying into Melbourne and holding that property for another 6 years, as opposed to sitting on your hands and doing nothing and sort of riding that Brisbane market out. Now, let me be very clear. I'm not suggesting you do that. I'm not suggesting people invest in property and switch every 6 to 10 years into a different market. The challenge with that is that there's risk associated with you. You might actually end up through mistake and through an unknown mistake buying an inferior quality asset, or the market might go through a prolonged weaker cycle, or the market that you sell out of could continue to rise. There's a lot of risks associated with this. And, we know that property works as a long-term asset, and that's where we're going to get compounding capital growth, even though we know that that growth isn't necessarily and almost never enjoyed on a straight line basis. So I'm not advocating that approach, but what I'm trying to do by using this example is trying to impart on you how important it is to think about the return on borrowing capacity. That if you've got borrowing capacity tied up in assets that just aren't returning, that scarce resource could be better allocated somewhere else. Now, sometimes I hear investors tell me, oh, look, I'll hang on to that property. It's not that big a deal. It's washing its own face. It's in terms of positive cash flow. So I'm not having to put any money into it. And if it grows in value, fantastic. But if not, it doesn't cost me anything. The problem with that approach is it tends to be far too simplistic because it ignores the opportunity cost of both the equity tied up in that property and also the borrowing capacity that it consumes. And so perhaps in that instance, you'd be better off selling the property. You could maybe move the equity into super and then reallocate your borrowing capacity to a better quality asset, for instance. But you need to look at that opportunity cost. The other thing that goes the other way that I've previously spoken about in episode 359 is that, you got to think about capital gains tax bill too, because there's a big opportunity cost with that. So if you've got a property with a huge amount of capital gains, maybe you are actually better off hanging on to it and delaying paying that capital gains until later, sometime in the future. Have a look at, if you're in that situation, go and have a look at episode, is it 359? Because I sort of talk about that in a deeper sense. But in my view, investors should always look to maximize risk-adjusted returns. There's little point hanging on to a particular investment if you're not being rewarded for the risk of owning that investment. So for example, if you've got something that's not really providing much cash flow, but it's cash flow neutral, it's sort of break even if you like, and it's still not giving you capital growth, then I'd argue you're not really being rewarded for the risk that you're taking. And you really want a fair reward for that risk. So if borrowing capacity is central to your strategy, if it's a critical to ensure you achieve your goals, then return on borrowing capacity is certainly something that you need to think about. Now, I've written a couple of blogs about, how to maximize maximize your borrowing capacity, because if it's a scarce resource, we should seek to maximize it in a safe and prudent way. And I've got a link on the blog on the website. Of course, you can find that the link will be in the show notes, to that blog I wrote back in 2023. But really, because everyone's situation is different and because credit policies change frequently, really the best approach is to work with an astute mortgage broker. So find a great broker. I've also recorded an episode about that, what I think are the attributes that a great broker possesses. That's episode 341, and I think that's really the best way to extend your borrowing capacity. If nothing else, I hope this podcast, and particularly this episode, and hopefully all episodes to some extent, are if nothing else, they're thought-provoking. And so I thought it was good to record an episode about this topic to really invite investors to think carefully about borrowing capacity and the way they utilize it. Because quite often we think like cash flow is our scarce asset, and it is, but there are other scarce assets that we need to really think deeply about. And I believe borrowing capacity is one of those. Okay, might leave it there for today. Campbell will be joining you next week with an episode about how to avoid the super death tax, which is a bit of a follow-up episode to one I did a couple of weeks ago on testamentary trusts. So until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.